Becoming a better saver can open the door to so much. You can grow a bigger emergency fund, you can enjoy more experiences, and you can also better prepare for your later years. But as you're putting money away, there are some things that could potentially slow your progress. So here's a look at what not to do when saving money. But before jumping in, this video is sponsored by public.com, and we will talk more about them in a moment. So the first thing you want to do is avoid as many bank fees as possible. Some banks will nickel and dime their customers and get as much money as they can from them. You have overdraft fees, lost card fees, ATM fees, and the list can go on and on. But while you might be able to wrap your head around charges for some services, many banks charge a fee just for you to hold an account with them. These are called monthly maintenance or service fees, and they cover the cost of maintaining your account. And these fees can range from $5 to $25 a month, which might not seem like a lot, but it does add up over the years. And to be fair, a lot of places do offer a way for customers to avoid paying the service fee. So whether you're with a bank or a credit union, make sure you understand the requirements for having that fee waived. And typically, a bank will waive that fee if a customer maintains a daily minimum average balance, which can range from $300 to $500. But there's also a way to get a no-fee savings account without worrying about account minimums. Some brick-and-mortar credit unions and banks have no-fee savings accounts, but your widest selection will be with an online bank. Online savings accounts like Marcus, Ally, and Discover are high rated, plus they don't charge a service fee, so you're able to keep more of your money. And as a bonus, these are also high yield savings accounts, which means you will earn a higher rate, so you're able to grow your money faster. Also, $1,000 isn't enough. And I've said this before, but I have to repeat myself because there have been so many times when I've read an article talking about emergency funds, and sometimes the person will give the impression that $1,000 is all you need. And when it comes to preparing for the unexpected, I feel that there are some misconceptions. I've heard people say that credit cards are only good for an emergency, or that you only need to save $1,000 for an emergency fund, but neither are true. And as far as the root of why some people think that $1,000 is a good enough emergency fund, I think I know where it starts. Because if you have someone who's starting from zero, meaning that they have absolutely nothing in savings, the recommendation is usually for them to come up with a plan so that they can save their first $1,000. And I think some people take that to mean that they can stop there and that they only need $1,000. But that's not the case, and $1,000 is only the starting point. It's a way to get some cash in the bank for smaller unexpected expenses that pop up so that you don't have to go into debt with a credit card. So hitting the $1,000 mark in your savings account doesn't mean that you should stop there. And just to make sure that we're all on the same page, a good-sized emergency fund, which is also referred to as a fully funded one, is typically 3 to 6 months of living expenses. Now, you don't have to stop there either. You might feel more comfortable with more money in the bank. And if that is the case, you might save 3 to 6 months of your actual income, or maybe 12 months of living expenses. Also, don't only focus on saving. And if you haven't already, it's also important to start wrapping your head around the idea of investing. Saving money is great. It offers protection against the unexpected, but a savings account might only take you so far, especially with regard to planning for the future and hitting long-term goals. So once you have a solid emergency fund, the general recommendation is to start investing some of your money. Not only does this help grow your money long term, but given how high inflation is right now, investing some of your savings also helps to offset long-term inflation. And platforms like public.com make investing so accessible to everyone. Public is an investing platform that helps you be a better investor. You can build your portfolio and choose from thousands of stocks and ETFs, as well as more than 30 cryptos. The platform also offers many features like commission-free trading on standard stock trades, safety labels on stocks that are potentially risky per the SEC. In addition, getting started on Public is simple. You can fund your investing account with your debit card, which is actually faster than traditional fintech deposits through the bank. Public also puts their investors first because they don't accept payment for order flow, which means that they don't sell your trades to market makers, which is how some investing platforms make money. And what makes Public different is their community feature. I like that on Public they have an interactive social community where you can share ideas and chat with millions of other investors, creators, and analysts. Public makes investing straightforward. So go to the link in my description to create an account and you'll receive a free stock valued between $3 and $1,000 when you make a deposit. You also don't want to save too much. And I know this might seem odd, especially since we're talking about the importance of saving money, but it is possible to save too much. With any savings plan, you want it to be realistic with your ability. Now, this doesn't mean that you can't challenge yourself to save more. You can, and you absolutely should, because you might surprise yourself. But one sign that you're possibly saving too much is having to constantly take money out of savings to get through the month, and not because you're overindulging. You might come up with a plan to save X amount of dollars every month, which is great, but is the plan realistic? Because even if you put that money away, you might notice that you're dipping into your savings account more often. And by the end of the month, when you look at what you actually deposited, maybe you had to go in and take out a third of that money, or maybe even a quarter of that money, because you actually needed it for your bills. And the reason you don't want to save too much is because that habit could potentially be costly. Banks will usually charge a fee if you have more than 6 withdrawals out of your savings account per month. Also, don't make your savings account too accessible. If you have a problem with impulse control, another big mistake you could be making is keeping your savings account too accessible, meaning you can easily and quickly drive to the ATM and take out money whenever you want. So if this is a problem that you have, I recommend making yourself jump through a few hoops in order to get to the money, and there are several things that you can do. For example, if you prefer using a local bank or credit union, maybe open the account with a bank that's farther away from your home or work, or maybe one that has few branches in your area. And of course, it never hurts to use an online savings account. It might take 1 or 2 days for your money to transfer, which can limit immediate access. Plus, many online savings accounts don't come with an ATM card. And finally, don't drain your savings to buy a house. Buying a house requires upfront cash. The down payment can be a minimum of 3 to 5%, and there's also closing costs, which can range from 2 to 5% of the loan amount. In addition, you'll have other costs like earnest money deposits and appraisals, so it can get expensive quick. And once you have enough money in the bank, I understand wanting to move forward with a purchase as soon as possible, especially when the market is crazy. But if possible, try not to drain your savings account completely when buying a house. Now, a lot of mortgage programs do not require borrowers to have a cash reserve after closing. However, for your own protection, you do want to try and keep something liquid. Now, I know that's easier said than done, and in a perfect world, your down payment fund should really be separate from your emergency fund, but I know that we don't live in a perfect world, and sometimes you have to do what you have to do. But if possible, try and maintain something in your savings account after closing, even if it's 2, 3, or 4 months worth of mortgage payments. That way, if something happens after closing, you will have some cash available so you don't have to use a credit card and get into debt. So that's all that I have for you guys today. Thank you for watching this video. I really hope that you enjoyed it. And if you did, please give me a thumbs up. And if you haven't already, definitely hit the subscribe button. I talk a lot about personal finance, and I typically post every weekend and sometimes during the week. So thank you again for watching, and I'll see you in a few days.